Good morning, good afternoon, good evening, folks. Michael Zuber, one rental at a time, back with Matt, the mortgage guy. How you doing, sir?
I'm doing good, Mike. How you doing?
Awesome, man. So something I'd love to do with you today is just give folks a kind of basic understanding of programs, rates, all of that for three categories. Because again, you're the guy that can service all three of these on my channel. One is the owner-occ business. Two, kind of traditional investor loans, like 1 through 4s, and then non-QM. And again, the reason I'm bringing you this is you service all three of these, where a lot of my lenders are very specific in one niche or the other. So let's give them some basic outlines of all three, please.
For sure. Yeah. And I went through and I kind of priced some stuff just because, you can blink in today's market and be off, right? Like you might've been looking at stuff 4 weeks ago. You're like, that doesn't seem that long ago. That rate probably still relevant. Mortgage rates change every single day. It's interesting to see too, because it's not always like in lockstep. I was probably not too long ago telling people, a rough estimate that might serve you 5%, 6%, 7%. When we're talking owner occupied, investment Fannie Freddie, and then investment debt service coverage ratio.
Yeah.
When I did the pricing,
that worked for a little while.
Right. Yeah. When I did the pricing this morning, I was like, you know what? Like as it moves higher, like the differences are less.
No, they're getting very, that's what I'm seeing as well. So it'll be interesting where these.
Yeah. And which, I mean, for a lot of your audience, for a lot of folks that I help as investors, these debt service coverage ratio loans, I'm getting more and more folks come across my desk. And when it's really close to conventional money,
just easier.
Right. Like let's do that. Even the folks that don't have the hugest portfolios, it's like, do you want to pull up 8 mortgage statements, 8 tax records, 8 homeowners insurance,
8
policies,
leases,
right? Tax returns. You got 4 different S corps and all that other stuff that can go with it. If you're not a plain vanilla buyer, the debt service coverage ratio loan is a great one. So maybe I'll start there.
Okay.
Which is traditionally like, the highest rate
of these three. Yeah.
Of these three in general, like these are usually structured with points. So I'm going to be super transparent. I'm going to talk about rate and talk about points.
Okay.
This is not an offer to lend.
No.
NMLS number 1088993. I got to say that just because who knows?
Okay.
Folks might be.
What was the number one more time? That was impressive.
1088993. So, you can go to the NMLS, look up my license, make sure it's valid. Make sure that I haven't done anything bad in the past. I wonder if people still do that. That's like,
I don't know. They're going to do it now. I guarantee you some of my followers are going to look now. It's like, oh, I got his number. I'm going to check him out.
A quick side note too, sidetracked. If you talk to somebody in like a call center and you get their NMLS number on that site, you have to actually report past jobs. So you can, John Walker, whatever the guy's name is in Quicken's call center, sends you an email or you get something with their NMLS number. You look up on NMLS Consumer Access. You might find like, yes, he's worked there for 4 months. And before that, it was Chick-fil-A. And before that, it was, you get to see the work history, right?
Yeah,
it's kind of a fun, easy way to figure out, how experienced that person is on the other end of the line. So
people now are going to go back to the video, rewind it and go, what was that number again? I'm going to go.
Right. Yeah. Make sure that I wasn't working at Chick-fil-A in 2021.
Exactly.
I don't know why I use that example. I really like their food. It's good stuff.
That's why you're having Chick-fil-A for lunch. I know what you're having for lunch.
Probably, yeah. I'm going to be sitting in front of my computer glued to the Fed meeting and just do DoorDash Chick-fil-A. Sounds like a plan. Okay. So debt service coverage ratio loan. These generally are just structured with points. That's the way it works. And so, you've got great credit. You're putting 25% down. You are probably in the mid 7s, about 7.5%. If you pay about a point in cost.
Yep.
If you paid a couple points in cost, you probably get that to about 6.99.
Yes.
And, a lot of times it's funny, the whole paying points things, I've had conversations with people more often. I feel like the investment stuff, they pay points and set it and forget it. When it's your primary residence, you might be more apt to refinance and do some stuff where it might not make sense to pay points up front, but nonetheless, that's where that's at.
Okay.
Investment property, same 25% down, good credit. 6.625 when I priced it this morning, cost about a point.
Okay.
So
could you get 6.5?
Yeah, sure. And,
Okay.
it's probably, 1.3 points or 1.4
Okay.
points, but you
You could get there. Okay.
you could be mid sixes there.
Okay.
And then primary stuff, which it's even interesting how much primary is pushed up to be close to
Yeah.
investment. You're at most lenders, you're going to pay to get under 6%. You're going to pay 3/4 to a point to get that 5.99. And here's the thing, we're talking about great credit. The primary one, I just plugged in 10% down. But if you've got 707 credit, 692 credit, and or 5% down, 3% down, these other things that are going to hit rate, you might be mid sixes. You might be high sixes. What did I look at yesterday? I looked at somebody who was out shopping and credit was good, but not great. 707.
Okay.
3% down, higher risk to the lender. So that's
Sure.
going to be a hit. That person's in the high sixes.
Yeah.
If they want to get mid sixes or even low sixes, they're going to be paying up front. And so, rates are up. It's no surprise. Just know your numbers. And I think as much as we talk rate and everybody focuses on rate, it just makes you adjust how much you're spending.
Absolutely.
Right.
Absolutely.
I had this conversation this morning with a friend of mine who said, "Hey, I want some friendly advice. If you have opportunity in the next 3 months and you don't have to pay 50,000 above ask, if you can pay ask 20,000 below, 30,000 below,
Yes.
Guess what happens when you get that at that price and the rate is 6.75? If the rates, and they probably will in the future, get to 4%, 4.5%, and you refinance that lower rate, it's good that you bought it at a lower price, but a higher interest rate, because you can't go back and change price.
No.
You can go back and change interest rate.
Yeah. The other thing I want to remind people is I have so many people, Matt, and I think you, at least for a time, you were in this camp as well. I don't know where you are today, but so many people are like, okay, the Fed's going to do their job. They're going to raise rates fast. They're going to raise rates higher than I'm comfortable with. But at some point in the next year or two, they're going to be forced to cut. Now, I understand the logic. I understand that there's a very good chance that they'll have to do that, but I'm not willing to make that bet. I don't want a 5-year arm where I have to cross my fingers and hope Jerome Powell or whoever the next Fed president is does that. The 1970s have taught us that rates can go up for a decade. It has told us that the Fed can be late and not act accordingly, a la Powell and Arthur Burns, who was the Fed president in the 70s. I would not make that bet. I'm personally only getting 30-year debt. I don't know where you come down on all that.
Right. Yeah. And I think that it's scenario specific, but that's the thing about buying at a higher rate where you qualify. It can't get worse, right? If you get into 30-year debt and you buy at 380,000, today, if rate gets better, refinance and it comes down. If it doesn't, cool.
You're good.
You're in the 6.25 or 6.5, wherever you're at. And so, what's going to happen is it's going to put a ceiling on some people to where like, oh my gosh, I don't qualify for more than 380 now. Oh, darn. The good news is you only qualify for 380.
Yeah, exactly. Write those offers.
Right. You can't spend any more than that. Right. And so like if rates were lower and you qualified for 480, you pay 480.
We had a lot of that the last year.
Right. Right. Yeah. And that's the thing too, is people in some sense are stuck, right? I don't want to get out of my 2.75% interest rate, never going to be able to pull capital out of my house because it just doesn't make sense. And all the other things that go with it. When you start at a higher interest rate, but a lower purchase price, you're actually better off in some sense.
No, I agree.
And so that's what I told my buddy too. I said, listen, do like Zuber. Start looking at stuff that's been on the market for 15, 20, 25
exactly.
days.
Right.
Those sellers are gonna negotiate with you.
Exactly. So if somebody wanted to reach out and really understand what the right loan is for them, what the rate terms or points might be, how do you want them to reach out?
Go to greatmortgagebroker.com, fill out the form, let us know where you're at, how we can help. Greatmortgagebroker.com. If not us, that's fine, but make sure that you go through those steps. If you're serious about buying, if you want to be prepared, if you want to truly know your numbers, for whatever reason, I've had more conversations in this last week, Mike, where people are like, don't pull my credit. I kind of want to get a rough idea. I don't know. And it's like, you're in or you're out, right? If you're serious about it, it takes a little bit of your time, but I'm paying for the credit pull.
Yeah.
I'm allocating, hours of the team's time and resource to put this together for you, so you know exactly where you're at. If you don't buy, no big deal, right? You're not, by getting pre-approved, you're not signing a contract that you got to buy something in the next 6 months. You
No,
might,
exactly.
you might not, right? But you want to do that work up front, so you know exactly where you stand, how much you can afford to buy, and more importantly than that is how different price points fit into your budget. And just, you should know those numbers. And that's why we're having the, kind of pre-approval renewals, where we're looking at folks and saying, okay, the higher rate, here's what it looks like. Know those numbers.
Yeah, absolutely. So again, folks, if you want to understand which option is right for you, what are the numbers, reach out to Matt, the mortgage guy. Where do you want him to go?
Go to greatmortgagebroker.com. Quick
Thanks,
and
bud.
easy, 5 or 6 questions. We'll be in touch.
Perfect. Thanks, bud.
Thanks, Mike.